David, your hedge fund Livermore Strategic Opportunities having its best year since 2016, up almost 80%. And a big reason why is because of your position in Tesla. At the start of the second quarter, your Tesla short was the biggest in the fund. It's a position you began in 2018 when Tesla was above $300. You covered your short at around $190, but you've reinstated your short position again. What specifically is going to drive the stock lower this time around?
Hey, Scarlet, thank you for having me. We crystallized a position in the middle of the second quarter as you started seeing a ton of different bearish notes hitting the street as far as the liquidity of the company and ultimately the company drowning in debt. That's typically, given the downside in the stock, we view that as opportunity, at least very short term, to cover our shares and lock in a profit that we held for over a year. That being said, we expected some type of bounce to occur. It did. We reinstated, I would say, a smaller position. And the view is that, Elon Musk is finding it very difficult, that selling cars are not as easy as selling stock to the public. And I think on a go-forward basis, it's going to be more difficult to show any path to profitability for this company.
It's interesting that you mentioned the debt load before, David, and to a certain extent the numbers showed more capital discipline going forward, a reining in of capital expenditure, a higher cash balance. Does that ease some concerns, or the fact that executives are still leaving and the lack of profitability, is that going to outweigh now the debt worries that you used to have?
No, look, first and foremost, for Livermore at least, we're always looking first at management teams, right? We want to invest in strong management teams that can obviously articulate the story and execute on the story. I think Musk has reflected that he's very difficult to work with, and he might have a dream of what Tesla can become, but I think you're seeing very quickly that this is no longer a high growth story. CapEx has dropped 7 quarters in a row. Key management executives are leaving. And the financials, even though he's been able, like I said, to raise capital, he burns cash very quickly as well. And the only way they were positive cash flow in the quarter, if you look, is because, again, CapEx was lower. So what's a sustainable path to profitability for this company?
Do you see the company having to raise cash again, and if so, how?
Yes, I think he has to raise capital again if he can't get to profitability. I think that's going to be the challenge. I mean, I think if you step back, you just have to look around. You look at Ford, you look at Aston Martin, you look at global auto companies throughout the world. It's a really challenging environment right now to sell cars. Mm-hmm. And this company needs to sell them in premium pricing, and they need to sell them at a high gross margin. And in this quarter, they reflected that they're not able to do that. Deliveries have been strong, but the problem is there's no profitability.